Just very quickly, you're gonna wanna see this. This is a trade on the Australian dollar I posted in the analysis section a few days ago. And here is the result. It was a range-bound trade on a 15-minute time frame coming off the back of a 4-day downtrending market. You can see where I went short and also then where I took the profit. Now, there's a few things going on here, but the important part that I wanna show you is that the framework for helping finding turning points in the market comes from the understanding of how to correctly identify support and resistance in the market.
Many traders fall into the trap of filling up the chart with lots of horizontal lines that cover all of the price action. The problem with that is that the lines start to distract your eye and you lose the story of the market and the understanding of how the areas of support and resistance were created. So in this module, you're going to learn a much more sophisticated way of defining support and resistance that connects it with the current and previous trend in price, and how supply and demand connect with support and resistance to create the turning points that give you the trading opportunities. Plus, if you watch to the end of the module, I'll show you how I use these concepts to help me frame a winning trade on the Australian dollar.
To fully understand support and resistance properly, it's a little bit like peeling an onion. There's a few layers involved that go together to make up the whole. Therefore, the first step or layer is to understand how support and resistance connects with a trend in price. Therefore, to begin with, we need to be able to define a trend. So how does a trend form? Well, it's actually pretty simple to define. In the case of a move higher, we're looking for a price that moves up and then pulls back, moves higher, then pulls back, moves higher, and then pulls back. That sequence of higher highs, higher lows, higher highs, higher lows, that is what we are looking for to identify an uptrend. And what we need to do is pay very close attention to these peaks that get created along the way. For a downtrend, it's pretty much a mirror image. What we're looking for is a market that pushes lower and then pulls back, pushes lower, pulls back, pushes lower, and then pulls back. And that sequence of lower lows, lower highs, lower lows, lower highs, that is what identifies a downtrend. Now, we need to pay very close attention to all these valleys that get created along the way as the market moves lower.
Let's look at some examples. In the case of an uptrend, all you need to do is follow the price up from the bottom and mark each of the swing high points or the peaks in the price action. Just connect a line to the peak that projects forward to the right hand side. In the case of a downtrend, it's the exact opposite. Just work your way down, attaching a line to each of the swing low points or the valleys that are forming in the price action. This is how we begin to define our areas of support and resistance, and more importantly, how we connect the support and resistance with a trend in the price. This is just the start though. In the next 2 videos, we're going to learn why areas of support and resistance form and how you can connect both of them to the concept of supply and demand.